On today's episode, we want to sort of focus on SPACs. It's been a hot topic this whole year. We've had a record number of market companies come to market via the SPAC route, and we thought we'll delve in a little bit more into it today, as we've seen many of these SPACs de-SPAC, which means, they've come out of the SPAC process and now they're trading as individual identity, and some of what's going on around these companies, some of these outrageous chart moves, some of the outrageous, manipulation going on. So we're going to talk a bit about that. But firstly, I'm going to let Jason just briefly describe what SPAC is.
Yeah, so you've probably, you've heard of them before, or you might already have some shares in some SPACs. Investors are using them more than ever before. Quick background, if you don't know or need a refresher, SPACs are special purpose acquisition companies, and they've been around for decades. And they promise companies can go public, more easily and with relatively lower fees compared to the traditional IPO. IPOs are usually pretty painful processes for companies. There's lots of regulatory paperwork, roadshows, and speaking to many investors. And also, they'll be paying typically 2 to 7% of underwriting fees to those investment bankers. That's why SPACs have become more attractive. They with SPACs, they're already publicly listed, kind of blank check companies. Then a merger will take place between the company and the SPAC, and now the company is a publicly listed company. So basically, it saves a lot of time, fees, and also they don't need to sell their shares at a discount to the investment banks pre-IPO. So that means the company gets to keep a lot more of the post-public listing upside for themselves. So if this sounds like such an easy route, why isn't everyone using it? Well, it may not all be as it seems, because the lower fees don't always translate, because the company actually has to give the SPAC sponsor a decent chunk of the company, and that can be up to even 20% of the company has to be given to the SPAC sponsor, and in exchange they only get promotion and obviously access to the pre-set up blank check company, which also has no assets. So that means if a company is valued at $1 billion, it gives around 200 million away to the sponsor. Now that's insane. IPO performances can be bad, but at least with the traditional IPO process, you have full disclosure and you know what you're getting yourself into. And many of these post-merger SPACs haven't been, having great performance, in our opinion. And Rajan will go into a few examples and a few cases of, what we see could allegedly be outright fraud. So what's your take, Rajan?
Well, I mean, saying that some of these SPACs haven't had good performance is a bit of an understatement. I think there's been well over 100 completed deals. Probably, I think it's over 120 now completed deals, and I think a good 90% of them are trading below $10, which is the normal. It's basically the reference price for the SPAC. So many, and now there's a good handful of them trading below $5. We've literally seen 20, 30, 40, 50% falls in a lot of these companies, even more than that. And it's just incredible the wealth destruction that has happened with these SPACs. And initially, we had at the beginning of the year where there was a SPAC frenzy along with everything else. It went alongside the meme stock craze. It went aside the crypto phase, where any SPAC acquisition deal that was announced, the stock went up 50%, 60%, 70%. People didn't really know what was happening, but it was just going up so much. And then now it's a total opposite. Well, we just recently had GGPI, I believe is the ticker, announced a SPAC merger with Polestar. And Polestar is selling cars. They're selling cars, 20 billion valuation, didn't move, stayed around $10 range. If that happened, if this was in February, March this year, that would have gone up to 20, 25 straight away. So now the appetite for SPACs definitely has calmed down. It's not got the same lure to it. In fact, any company coming public via a SPAC right now is sort of getting the stigma of being a bit of a scam. That's the way the stock is trading anyway. And if we look at some of the ETFs for these SPACs, there's a few of them, but one of them is the Morgan Creek SPAC, trades on the ticker Sierra Papa X-Ray Zulu. That ETF, I can just show you now, is basically they don't allocate more than 2% of the portfolio to a single company, and it's either to a SPAC name or a company that has de-SPACed. And if we look at this chart over here, we can see this is the incorporation of the ETF, and that was in February. And then since then, all we've been doing is going down. So this is a well-diversified SPAC portfolio, which has companies like DraftKings, which is probably one of the most successful SPACs in this. And all we've seen is just a progressive downtrend. And literally since February to now, so we're looking at about 6-7 months, we have fallen about 40%, 30 to 40%. And that's in a well-diversified SPAC, you know, so it's insane some of the moves that have been happening. And in terms of some of the notable ones, which have been absolute dogs, Catapult, one of them. So, you know, they came out with their slide deck projections initially when they were about to come public. So this was in December 2020, and they projected 455 million in revenue for 2021 with 47 million profit. They report their second quarter earnings. What happens? They withdraw their outlook. Reported 1.5 million, 1.5 million profit for that year, for that quarter, and the stock is now trading at like $4.60. So it's just totally tanked. And another one is App Harvest. That's supposed to be the new, was it the green, the sustainable farming play? Yeah, the vertical integration farm play, the sustainable one. And, you know, there's a lot of hype around this, the technology, everything that was going on with it. And we actually went from 10 and it went to a high as 39, I believe. And now it's trading just below 7. So
yeah,
that's another one.
I got pretty stung on that one.
It
to be
was
honest, I have, you know, obviously put a small amount of my portfolio into some of these SPAC names. Some have done really well, like MP Materials, and some have done really terrible, you know, App Harvest.
Yeah. I can name you too many bad ones that I've been with. No, but the worst thing about it, the worst thing is that on all of them, I've been up massively. But for some reason, you just get brought into this whole thing that is going to keep on going up, and then for some reason, you know, diamond hands. You know, I should have had paper hands, and I've done quite well with the SPACs. But
it's true. Even Clover, you know, that was, you know, trading around 12, and then you know, it dropped down to, I think, the 8s and 7s, and then it had a massive Reddit push, you know, into the, you know, high 20s. You know, I sold a bunch then, but I should have sold it all. But, you know, I was just trimming the position down, and then now it's
that's it. Yeah, so, you know, it's App Harvest. That was, you know, so in their May 17th, 2021 slide deck, you know, they projected revenues of 25 million and adjusted EBITDA loss of 52 to 48 million. And then just literally a couple of months later, 2 to 3 months later, they slashed their revenue forecast to 79 million and expecting an adjusted EBITDA loss raised to 75 to 70 million loss. And I mean, literally,
that's criminal.
Yeah, it's criminal. Like, how can you in your slide deck project something and 1 or 2 months later literally go, no, didn't quite work out? I mean, App Harvest is very early stage, so it's not like the visibility. They can't have been thinking that short in the future when they were coming up with that slide deck. It's quite criminal what they did over there. And then, you know, a couple of other ones that I got here. Romeo Power, that's another one. Was, you know, before it de-SPACed, it went up to, I think, 30 almost. It's literally around 3 or 4. And then TMC, which is the metals company, that is another one. Now let me just show you the chart of TMC. And yeah, the TMC initially traded around $10 and went to about, I think it was around 20, no, 15 after the SPAC. And then what happened? The CEO misrepresented the amount of shares in issue, and then this is what happened. So it's literally
Insane.
it de-SPACed, it went up to as high as 15, and now it's trading at $3.55. I mean, that's down 65% from the SPAC price. And basically, I can show you numerous charts like this where you've had this short squeeze just off the de-SPACing procedure, and then afterwards, as the shares come out, the insiders are all selling. The SPAC sponsors, they're all just unloading quite clearly, and they absolutely obliterate the stock and just killed shareholder value. And then we had Lordstown. That was another one. Lordstown Motors, again,
Allegedly.
Allegedly. I mean, they reported their Q2 results, right? And they said that their Lordstown plant was ready for production and ready to begin vehicle production in late September. And they raised their CapEx forecast. Then what happens? Literally moments later, they disclose that they need funds for 2022 production ramp up, and they're to limit the amount of spending to preserve liquidity. So literally, they reported their quarter, said they're on track for production in September 2021. Moments later, like literally a week later, they come back saying they need cash. So, I mean, how can you do that with no oversight? And it's just so many like this. And Ride, I don't know where that is trading right now, but it's another one that has absolutely, $4.86. Went to a high of $32, and now that's trading at $4.36. And then,
especially with these automotive ones, it just seems like everyone wants to catch the next Tesla, right? They want to believe so bad that this is going to be the next Tesla. But you know what? Everyone underestimates how hard it is to take a prototype, which is relatively easy, to mass production. And that's seriously super hard. When you think about it, there's only two American companies that haven't gone bankrupt, and those are Ford and Tesla. And Tesla, well, they were so close, in 2018-19 to going under. But that's how hard it is, right? It really is hard. Now, these guys, they're trying to pitch the vision to all these retail investors who don't just think, oh, look, these guys have got a prototype. Or some of them, sometimes they don't even have a prototype. They say, yeah, we're going to go into production off some renders. It's just insane.
Let's talk about Nikola. That's the original. That's the OG in terms of SPAC scams. That one went up to almost $100 from 10. And then what happened to that?
Oh gosh, yeah, we got burnt pretty bad on that, but not because we were buying it. We were trying to short the crap out of it because, we had a really good inkling that this was a fraud back in May last year, or even before. And we were like, wow, how has this company got such a large valuation? We have to short this. But little did we know that we were getting played by
we just got played by the big boys. Absolutely,
definitely. So Rajan, just explain the trade.
Well, I mean, so what happens, and what's happening with a lot of these SPAC names, is that the initial float that comes to market. So what happens is that when a transaction is being completed, there is a warrant exercise. So the people that hold warrants can choose to, I guess, exercise their warrants. And what happens is that if you've got a high acceptance rate, pretty much a lot of these companies, they don't have many shares available to the market. So if there's a large amount of people that have exercised, the actual free float is so small that you get wild price swings, and it's very hard to short. So the cost to borrow goes through the roof. So
that is by design. I think it's
100% by design. And I've seen it with IPOs right now. Like they issue some mega low float, and then what happens is that they just try to squeeze the short sellers, and then you get these incredible moves, which is bananas. And so Nikola, at the short interest rate was at like 700 to 800% at one point. That's how hard it was to borrow shares, because all the shares were locked up. And then as the unlocking happened over time, and shares flooded the market, then obviously everything changed and it went down, and it went down to its rightful place. But at the time, we got, I guess we weren't educated enough into this particular type of, I wouldn't call it a scam, but like technique that's sort of happening. And I saw these, I could sell the 45 call and buy the 20 puts at almost the whole size of the between the strikes. So I was selling it almost for $25, and the width of the strikes were $25. So I'm like, okay, this seems too good to be true. I'm risking, I'm risking 10 cents, 20 cents to make 24, 25. This seems too good to be true. So straight away, I didn't think about anything more of that. So at the time we just put it on, and there's something, there's some of the telltale signs were that the puts, like, the stock was at $70, but the 30 put was still trading at $10. Like, how is these puts so expensive? And obviously these puts have priced in this mega high borrow rate, right? But what's happening is that the whole arbitrage is that you put on this trade, and there was virtually no intrinsic value on the short call. So what happens is stock was at 65, you sell in the 45 call, and basically the price of the 45 call was $20. So there was no intrinsic value. So that is why you could pretty much get the whole width of the strike. And so what happened is that, you put on a trade, and then the next day they exercised you. And what happened, you were left short the shares, but you now had to pay this massive borrow rate on the 400 notional. And at the time it was like $60 a share. So each contract you got filled, you were like 6,000 short. I mean, it was a $6,000 short position, and you were paying annualized 700 to 800% short borrow, and that's how we got fucked.
And yes, that's exactly how we got done. But the thing is, look, see, this is how you learn. But one thing I'd say to all of you guys out there, if you are going to try a trade like this, just don't do it on a Friday, right?
Yeah,
especially a Friday evening, because what happened is I put on a whole bunch of contracts for that, on that same trade Rajan was talking about. And it was Friday evening, and I was thinking, you know what? This is my lottery ticket. Let me just put on a whole bunch. And I was buying more and more. I think I bought 60 or something like that in total. And the next morning, I look at my brokerage account and I see I'm like $1.4 million down or something like that. I called Raj straight away. I was like, what the hell just happened? We did not realize our major problem is we just didn't look at the borrow rate, and that had just jumped up like crazy. And so I had to wait all the way till Monday to try to unwind that position. But I think I took about 60,000 loss just basically on the interest, which was just insane. Incredible. And then obviously we just unwound that, but we took the position that we had really been played. And like I think I waited about maybe 2 months until more shares were kind of put on the market, and did some short positions then, and accumulated a bit back. But it was really sour taste in my mouth always doing shorts.
The worst thing is there has been other instances. Another one is IronNet, and I'm sure people who are in this space will know about this one. IRNT, similar type of thing. It was 10, 15. It had a mega low float. Stock went up to 50, 51. It's now trading at about 12, but you could not short it. And I was looking through every way I could possibly do it. And the thing is that you might see the stock at like 15 or 20, and you might put on, let's say, a butterfly, or you might do something, and then before you know it, it just goes through the roof, and that's when the borrow rate goes through the roof, and then you're already in a position and you just get a bit screwed. And sometimes you're stuck. But one thing I realize is that there is no real play, and if there is, feel free to leave it in the comments. But unless you just buy the puts outright, but you have to pay a massive premium because what's happening, you got the borrow rate baked into the put, so you can do it, but you really have to pay for it. It's not going to be a low risk trade. But the thing is, if you do buy them, you can get paid if it does what you expect it, as long as you have enough time for it to come to fruition. But there's no cheap play. The whole point is you've got to pay for them puts, and as long as you're willing to do that, I guess that's the only real play you can do. Because the thing is, with all of these stocks, like it happened with QuantumScapes, happened with Nikola's, happening with IronNet, pretty much happened with everyone. Everyone has done exactly what you'd expect it. It's had this short squeeze up to some stupid number, and it's now tens or below. So they've all done exactly what it is. So I guess the main play is just to pay up for them puts. And, if you can sell like the 25 put when it's at 50, even though if you have to pay $10 for them, they're going to be worth 12, 13 when it goes back to 10. So the question is, you're getting 20, 30% on your $10. Is it worth it? Well, who knows,
Who knows? But the thing is, it really, it just makes you a bit sad because the SPAC route could have been like a legitimate great route for companies who wanting to list, but it's been used by so many companies who literally have nothing, that just want to profit, and kind of has given it a bad name, and it's taken down people like Chamath, who have who's trying to he's been a
he was a god. He went from hero to villain. Yeah, pretty much.
Yeah. But the thing is, his intentions weren't bad on any of them. It's just obviously the market pricing of these SPACs. They're just ludicrous interest at the time that he was putting IPO BCD to the market, and the market's going to do what the market's going to do. They're going to price things correctly in the long run, and I don't know. Is it bad to feel upset? I mean, people obviously, if they
everyone's
going
to be upset when they lose money. Yeah, that's it.
Yeah, exactly.
It's like if you someone's making money out there. That's the thing.
Yeah.
But I mean, it looks like the SEC, they definitely have taken a note of everything that's going on, and they do. We did see comments from the SEC not that long ago that they did note that they're going to aim to increase disclosure of costs and dilution of later stage investors and make that much more readily available to people who are getting into these SPACs. And they're also going to be seeking input on whether digital customer engagement innovation need to set new regulations. So it's going to, there is, a lot of work on the regulatory side, and let's just see if they enforce any of that. But I mean, the
main thing is, is it going to stop these retail investors getting so excited and jumping in? That's the main thing.
Because there's another one. There's a different one every week. But the thing is that one thing I try to do is now try to see what's the best way to trade them. And with IronNet, I found out the good trade is when you get these massive moves and the implied volatility goes through the roof. I feel that they're good calendar plays. Like if there's any play that I could do, I would say the calendar play was probably the best ones, because you could have sold like the November 9 or the 10 puts when the stock was at 40, and then bought the February one, which is 3 months afterwards, and you're paying 10 cents, 20 cents. It was incredible. Like literally the November and the February 10 puts were almost trading at the same price. So, I mean, I just sold that was one trade that actually did pretty well. Like I sold a bunch of IronNet 10, 9 and 7.5 calendar spreads. And then what happens is that when it all sort of deflated and now it's come back down to the 12s, the February puts haven't obviously, the February puts are like probably the same amount, but the November ones have gone down by 50%. So that 10, 20 cents now turned into 70, 80 cents. And the thing is, you can just take your profit right there. Or so I took half of it out at like, for about a 300% gain on the small amount I risked. But the rest of it, now I'm just waiting for that November's hopefully to expire, and then just keep on rolling it to February and hopefully just make it a pretty good trade. But then other than that, I mean, there are some good specs out there like Sophie, I believe. You got,
that's a good one.
Yeah.
You
So I
got
mean,
Matterport.
Matterport's a good one.
Yeah.
I mean, yes, I mean, Sophie, Matterport, all of these, I mean, what I'm doing with them, I'm just basically, Sophie's still not really gaining traction. It hit a high of about 30 and it's now teetering around 15, 16, 17. It's sort of consolidated around that area and it's looking for that bank charter. But I think, right now, if it, when it gets to around 15s, I just try to sell some 13 puts or something like that if there's a bit of premium available. But it all depends how juiced up them premiums are, because sometimes you don't get really much for it, so it's not worth it. But I mean, what are you playing right now?
Definitely, like you said, the SoFi puts. I sold the 14 put recently, and yeah, like you said, you're not getting too much premium for them, but I'm just using it to try to lower my cost basis, because obviously I like to try to accumulate some more. But yeah, I mean, so with the specs that I'm looking at, now if I am going to put some money in, that company must have something seriously good behind it. Like MP Materials, they had an amazing, mine which they turned profitable. And obviously you can't replicate any of those type of things easily, and the metal ores that they have available there, is a strategic hedge against, China being the dominating force on, supply of those type of rare earth materials to the US. So something like that is still a good play, in my opinion. But yeah, let's see what else is out there that's gonna be. I think I like the markets without all this euphoria. If there is a spec coming to market and there's a lot more, intrepidation, people not feeling so, going gung ho into these specs, it's actually, a better.
It's a good opportunity to maybe find a hidden gem like that's literally been sold off hard on the back of it being a spec.
Yeah, definitely. Yeah, so let's see. What do you think is going to be the future of specs? Do you think that, a lot of the companies that maybe potentially were considering them for like 22, 23, are going to go down the traditional IPO route, or do you think that the specs still have legs in them?
Well, I think from what I'm seeing now, like obviously the amount of specs being announced every day, I mean, you literally might get one a week now, one or two a week, but before we were getting two or three a day. Now the thing is, if you're a company like Stripe, or you could even say SpaceX or someone like this, as someone where there is so much demand, there's no way they're going to go through the SPAC route. They're going to go through the traditional IPO route. But the thing is, the thing about these SPACs right now is that a lot of them are just too early stage. And the biggest problem is they come in with some ridiculous valuation. Like if you read the slide deck, they're saying, they're making 1 million revenue now, and by 2026 we're going to make 2.7 billion. And it's this incredibly nutbag projections, and then they said because of that we're valued at 1.5 billion today. And then
this is QuantumScape in a nutshell. Basically, they have been around for I think 11 years or 12 years, and the reason for SPAC is just so the early stage investors can get paid out, because this is a solid state batteries are still a long way away, and you're literally, if you're putting money into something like QuantumScape, you're putting money into a science research project, because they haven't even put their batteries in cars yet to test. They're still in pouches And, they say theoretically it should work, but it's not about having it in the lab. It's about getting it to mass production. And then once it's in mass production, so let's just say you perfect that whole process, which might be 2024, 2025, or, then it's all the validation. Is it going to blow up? What's going to happen when my EV is sitting in Phoenix, like 50 degrees Celsius, for ages, and these varying vibrations and, temperature swings, and, even high utilization of the batteries when, you're accelerating hard and or whatever, all those things. How does it take its toll on the batteries over time? That's the big thing. It's not like, oh yeah, it's with internal combustion engines, there's so much history behind it. They know how it works. But with these state-of-the-art solid state batteries, no one knows them. That's why your standard, I'm going to say standard, but like, your LFP or your lithium nickel phosphate, sorry, your LFP or your nickel-based cathode lithium batteries, they have years behind it. If you are an automaker, you don't want to have warranty recalls. Look what's happening to GM, right? Obviously, they blamed it all on your the suppliers, I guess, like LG Chem, and saying, hey, you need to sort everything out for the batteries. But I don't know. Do you want that brand reputation damage? I don't know. But anyway, getting back to QuantumScape, look, people are really excited about solid state batteries, but just really look into what's the company doing. Okay, yes, they have developed one, but yeah, that's just in a lab. Really look into it. And I'm not just talking about QuantumScape. I'm talking about even like we put in some money into App Harvest, but really, it's a great idea, but is it a great business? That's what you need to look into. Are they really going to make those profits that they're saying they are? And it might take a lot more research and time and dedication, but it's something that would be your portfolio will thank you for in the long run, right? I guess sometimes with these specs, you put in a very small percentage of your portfolio, and I think it's just worth a punt. But anything more than that, you have to have you have to have a real conviction in it to take it your portfolio to the next level. So my message is just either do your research or stay clear for them at the moment.
Yeah, well, I think that's a good discussion. Probably wrap it up here. But yeah, we'll definitely catch you on the next one. Going to be discussing all the hot and current topics that are going on, and still be looking to invite some people onto the pod as well, so we can get some expertise from some of these guys in their relevant field. So it'll be exciting times ahead.
Definitely. And if there's anything you want us to discuss, any particular niches in the markets, or anything about ourselves and our strategies, just leave a comment in the comment section below, or get in touch with us at average_traders on Twitter, and we reply back to all comments. So thanks again for listening, and we'll see you in the next one.
Don't forget to subscribe.
Subscribe.
Subscribe if you want. That's it.
And we would appreciate a like, because that helps with the YouTube algorithm. And just tell your friends if you found this podcast useful. And we'll see you in the next one.